We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to talk about how history rhymes. I encourage you to go back through the blog and look at the most recent blog posts. We talk about the no-bid market and how this market is structured differently than previous markets in history. We look at the relationship between stocks and bonds. We look at gold. And on a side note, I encourage you to go to Information FAQ, scroll down the information page, or do a search for how the stock market works and also the crash in 1929. And just to get a cup of coffee, sit down, take an afternoon, 2 or 3 hours to review it. You'll find that the information videos of the 1929 crash, I'm not saying that's going to repeat, mind you, but it's quite amazing how much wealth gets concentrated in such a few amount of stocks or a few amount of products. And obviously if you go through our blog, you'll see the picture of the Amazon stock, you'll see the picture of Apple stock, and you'll see how crazy they look. Anyway, let's get back to looking at history rhymes. Here we have the Dow Jones from March 2009 to now, 10 years, with hardly a decent correction along the way. You see that there's, I think we're looking at maybe a 20% correction here, which is hardly a blip. This is 12. This is about, I don't know, 10. So you can say this is a pretty stable, straight up market. Now we have 200 years of Dow Jones daily data on readtheticker.com. So what I want to do is I want to take this data here and say, let's go look at history and 200 years of data and what happened after 10 years of plain sailing. So we took this, went to our period scan. We put in our range dates. There's lots. You can make this as complicated as you want. So we scanned 10 years of data between these two dates, March 09, October 2018. We want to scan other 10-year periods within the 200 years of data, and we get our highly correlated results. Drop down there. And this is the start date. So I've picked out 2 relevant periods. Now, 10 years of data. That looks like. Whoop, so it looks like this was found from 1988. 1988 to 1998, which is about 10 years. That's correct. And look what happened after that. So we had plain sailing. This is just after the 1987 crash. Pretty much plain sailing. Hardly any decent corrections. A bit of a excitement at the end. And as you can expect, as life always happens in the market, volatility increased. Corrections got very serious. And then we got a major top. Another scan period, plain sailing. This one here is probably more correlated because here we had a bluff. For example, the previous chart I showed you was from here to there. Okay, so these are the only 2-year period. So only 2 times for 10-year period within 200 years of Dow Jones data where this has happened. So you got this period here and that period there. Okay. This period, blue period here, is this period between the 2 arrows. This is the other period. Quite frankly, this period here is more correlated to the 78 to the 1988 period. Close enough. 87 period. Right, as obviously we had a big crash, a bit of excitement here. A situation like that, excuse me. A situation like that, this where it falls dramatically quickly, fall quickly, sorry, is on the table. Have a look at this market. Up, smash down, smash down, smash down. Algorithmic trading has introduced the fishing rod approach. Alright? It goes up nice and gently and just falls like dramatically at the end. So, I believe you can probably 90% chance the next 2 years after the midterms. We don't know whether Congress is going to be in charge. The odds are incredibly high that Congress may be in charge. But we can guarantee, I would bet heavily that large swings in the stock market are going to happen. Whether we get one massive dramatic swing that shocks everything out, it's enough volatility to last us 2 years. This volatility we had here shocked everybody, and it pretty much was the volatility that allowed, for the next 2 years to be pretty stable. But we get, volatility, but not all in one go, but spread out. Okay. Now I'm not saying we're going to get higher highs. We might go sideways. Might go sideways like this. Okay. But I believe, and I think you'll agree, after 10 years of relative stability, low interest rates, we're entering a world where the swinging market and the volatility is going to be back. More so than ever in the next 2 years. Is because we've got the risk of change in Congress, higher interest rates. Now, higher interest rates are incredibly important. When interest rates were near zero, that means they were out of the game. You had S&P dividends which were greater than interest rates. Hedge funds could produce 3% and they could be rock stars. If you could produce 2 or 3% every year for 10 years, you're beating the bond market. Great stuff. Now, if interest rates rise on the 2-year and the 5-year, they go to 3 to 4%. Institutions are going to go, that's probably about 70% of the hedge funds flush down the toilet. Why would you give money to a hedge fund when for 3 to 5 years you can get a good interest rate? It just lifts the bar. Interest rates lift the bar not only in the hedge fund industry but also in the investment model industry. Because if you've got $1 million, $100 million for 10 grand, and you want to invest it into a company, into a scheme or what have you, why would you do it for only a 3 or 4% return when you can go and get a bond to pay the same amount? It raises the profile. And interest rates should never have gone to zero. The morons and the bankers don't understand that keeping a high interest rate allows the correct allocation of capital in the market. So, interest rates go up, dumb money gets obliterated, that creates volatility, opportunities open up, we find out who's been swimming with no trunks and who gets embarrassed. What it does mean, I think a pretty good bet, is that now that there's more risk in the market with higher volatility in the next couple of years, portfolio managers and everyone's going to say, this is a bit scary, we're going to have to create more hedging, allowing for that 1%, 10% chance. That's why I believe the precious metal market, the gold stocks, are going to get a bid. Because the last 10 years, the market's been tamed. The lion in this market has been tamed. Well, I'm afraid the lion's going to be roaring right back. And the risk is going to be there. There's going to be volatility, where it's all in one go, or spread over a few consolidations. Whether it's higher highs or higher lows, volatility is going to be back, and there will be a bit in the market for gold, silver, and other commodities. I think that's pretty much an easy forecast. The other forecast is, of course, we've had 10 years of easy, low interest rates. We're going to have another 10 years of easy, no interest rates. Never happened before. Ever. Or even 2 years. I think that's low odds. So I'm going to give it 80% for the chance of more volatility, higher interest rates, more demands for hedges, more pressure on hedge funds to make better returns, better than the bond market, better for risk. It's going to sort out the men from the boys. Dumb money's going to leave. Back to the good old days where skills in the market actually mattered. It's going to be fun. Keep an eye on readtheticker.com. The tools within the website will help you through this period, because the cycle is going to be back. Wyckoff Logic's going to be back. And understanding a few GAN tricks is going to be back. Thanks for watching.